There are many different financial vehicles where you can store your money and build your wealth, each of them with their pros and cons. But imagine for a moment that you could create the ideal financial instrument. What would it look like? Or more specifically, what characteristics would it have? You would probably want the ability to access your cash anytime for any reason without having to qualify for it or without incurring any penalties like you can with your checking or savings accounts. Generate a guaranteed positive return like you get with bonds or certain annuities. Access the growth on your money without having to pay taxes on the increase like you can with a Roth IRA. Use your money as collateral to secure a loan like you can with real estate or other property. Protect your money from creditors and judgments like you can with 401ks and IRAs. Bypass the probate process by going directly to your beneficiaries, income tax and estate tax free like you can with certain types of trusts. Leave a legacy for your heirs or loved ones in the event you pass before being able to reach your accumulation goals like you can with life insurance. And continue to contribute to your account in the event that you become disabled and unable to work like you can with disability insurance. But what would you call such a financial instrument? The wonder tool? The Swiss Army knife of financial vehicles? Actually, it already exists. It's called permanent life insurance. And although it's been around for over 200 years, it remains one of the least understood tools in the financial industry, even by advisors themselves. That's because most people try comparing permanent insurance with term insurance, thinking they are the same thing and that they provide the same benefits. That's the equivalent of trying to compare the price of a car with the price of 4 tires. While a car does have 4 tires, it obviously has much more than that. Permanent insurance and term insurance are two very different products, and the benefits they provide are vastly different. At its core, term insurance is a lot like gambling at the slot machine. You give some money to the insurance company, and if your number comes up by the end of the spin, they will pay your beneficiaries. If not, you must pay to play again. Only next time, you'll have to pay more because the odds of your number coming up will have increased. So, over time, the cost to purchase the same amount of term insurance continues to rise higher and higher. This is precisely why less than 2% of all term insurance is ever paid. The cost to continue coverage simply becomes too prohibitive, so the coverage is dropped and no benefit is paid. Permanent insurance, on the other hand, is not like gambling at all because the payout is not contingent on whether you die during a specific period of time. In other words, your beneficiaries will receive the death benefit regardless of when that happens. So, with permanent insurance, you're paying for a predefined, specific benefit that is guaranteed, not a benefit that is contingent upon an event that may or may not take place during a specified period of time. But that's just the death benefit, which is all there is in term insurance. Permanent insurance, on the other hand, has both the death benefit and many living benefits as well, which you can enjoy during your lifetime. As mentioned earlier, permanent insurance shares many of the most desirable characteristics of several other well-known financial products like checking and savings accounts, bonds and annuities, 401ks, IRAs and Roth IRAs, real estate, and even trusts. However, unlike those products, a permanent insurance policy does not require you to qualify to get your money back, like with a mortgage, does not penalize you for accessing your money before reaching a certain age, or require you to begin withdrawals, or limit the amount of your contributions, like a 401k or IRA or Roth IRA, does not restrict where you can put your money, like most qualified plans, does not burden you with an unknown future tax liability like 401ks and IRAs, does not subject your hard-earned money to real estate or stock market declines like real estate, stocks, bonds, and mutual funds, and unlike term insurance, does not require you die before you can benefit from the policy. Plus, a properly structured permanent insurance policy is the only vehicle where you can use your money for anything you want and still earn interest on it as though you hadn't even touched it. As you can see, A properly structured permanent insurance policy shares many of the favorable characteristics of the most popular financial instruments around, while avoiding nearly all of those that are less desirable. This means you can have more liquidity, use, and control of your money. The facts speak for themselves. These characteristics make permanent insurance the perfect vehicle for operating the infinite banking concept. By becoming your own banker, you will soon be in a position to stop supporting the employees and shareholders of other banks and finance companies through all of the interest you are paying to them, and instead use that money to support you and your family, now and in your retirement years. Becoming your own banker will prove to be one of the wisest decisions of your lifetime.